Hey everybody, Preston Brent here with our weekly roundup for our trader user group. This is for the trading week ending February 9, 2018. What a crazy week this was. We saw the Dow fell 5.2%, S&P fell the same. NASDAQ came in closely behind, down 5.1%. And I guess market closed this Friday. We had an official market correction with the Dow and the S&P pulling back more than 10%. Really amazing. And I'm hearing the TV talking heads talk about, well, the market's falling because we got too much growth. Well, really, the underlying concern is potentially rising inflation. Wage growth is kind of a predictor of that, and it's forcing 10-year yields to move up stronger at a speed which is more alarming than just the height that the interest rates are going. But I think there's another thing at work out here that it's not covered on TV on the business channels, but is a big one, and that is the what the Feds are doing right now. They're taking money out of the markets. Late last year, I was talking about this, where there was quantitative easing for many years, probably 7 or 8 years, where they put over trillions of dollars on the balance sheet. And now we're taking it out to the tune of about 30 billion a month. And then starting in July, it's going to go up to 40 billion a month. And then in October, starting in Q4, 50 billion a month. So for all told this year, the Feds are looking at taking $450 billion of liquidity out of the market. Folks, there's got to be a reaction to that. And the markets are reacting with higher interest rates. And we could see it get worse from an interest rate perspective. But on the good side, we've got synchronized global growth. We've got earnings per share coming in over 18 or 15% growth so far through Q4 earnings that we're running through right now, the earnings call. Our PE ratio is coming down a little bit. So the forward earnings for the PE for the S&P is at 16.7 now versus 18.8. So those are all good things. Also, the Fed Fund Futures is estimating a probability of a rate hike, 3 rate hikes this year, at only about 44%. At the end of January, it was almost 60%, meaning they believe the Feds are probably not going to be as aggressive. And that's one thing that Feds could do, is just slow down the rate hikes. But if they've got inflation on the horizon, they may be boxed in a corner. And all of this QE and all of this stimulus is going to have a counter effect to it. It always does. It just takes some time to play itself out. Volatility, meanwhile, we broke our 404 trading days without a 5% drop. We got that this week. And we had a very crowded trade in short vol by the big money, big hedge funds. And they all had to unwind their trades of the Monday of this week, and we got that vol pop over 50. So all in all, we're going to see volatility stay high for quite some time. I'll show you the charts and show you what I mean. The chart I got on the screen right now, it looks like Bitcoin, but it's the S&P 500 E-mini futures. Amazing drop. Just really amazing how far this thing came down. And if we look at it, you can see I got a lot of volume over price right down in this area here. That's kind of where we're situated right now, where we closed right here. We moved all the way down. We tested the same lows fairly close to it. And then we finished up in this upper quadrant here. Now, in 2016, when we had a pullback that was even greater than this, we're over 15 or 16%. We had a run-up, choppy run-up that lasted for about 2 weeks. We came back down, we tested it again. In fact, we made a lower low. Then we consolidated, and then we started our year-and-a-half run that carried us all the way through to end of January this year. All right. So I believe we still have some lower lows to retest, but I do think we're going to get a little bit of a bounce. Now, for those of you that got stuck, you may want to use this run up here to maybe unwind some trades or take some money off or go a little bit more to cash so you can take advantage of it, right? So if we do have over the next few weeks this run up, I'm looking at this target area right here, which is a key level before we really gave it all up. And you can see right in that area there that we're going to have a decision point in the markets. I'm not sure if we'll be able to clear that hurdle. All right. And it's going to take a couple of weeks to get up there. It'll be very choppy. And if we do make it up there, then I'm going to look for a break. If we come back, test, and hold, that'll be even more bullish. I do not think we're going to get back up here for at least 3 to 6 months. We may, but the odds don't favor it. Okay, so that's what I'm looking at on the S&P 500. Really ugly. If we step it out for a weekly, just so that you can put a little bit of more perspective on it, you can see here on this weekly chart, this big move here. Now this shows up, and this goes all the way back to 2016. And we had a huge, huge fall. Never in the history of the markets have the markets fallen from an all-time high into a bear market. And what would a bear market look like? Well, a bear market right here, let me just put my ruler on here and move it down to 20% just to give you an idea where we would go. Right in that area there, which is an area that I've already marked on my chart as a key holding area for the markets, right? Right around the 2300, 2200 area, or just above the 2200 area, right? Right in that area right there. All right, and that's where we kicked off 2017, right? Right in that area there. We kicked off 2017 and we started the run. I don't think we're going to give up all of 2017. I think this is a legit move. The move that's not as legit is starting right in this area right here, right? And you could probably even say down here at 2600, okay? And then we started that move up very strong. So giving all of that away, this is a normal move, and then a little bit of a pullback, and then like that. So that puts us down beyond the 2500 area, which I think we will go. And the momentum may carry us there next week, but I'm still expecting a rally here. If we come back and look at 2016, okay, and let's just go all the way back to January of 2016, just so that you can see, all right? We'll get there. Okay, here we go right here. If you look at January 2016, notice here, it didn't do it in 3 or 4 days. It gave it up, attempted to make a retest. We didn't make new highs. We gave it up. We made a lower low here from this low here, and then we gave it up, came down, made lower highs here from here to here, and then when we came down and we took all of this stuff out right here, that's when we went for the races, right? Then we had this 2-week period where we had a nice rally and rolled back over. Now that doesn't look like a lot, but it is, because at this point in time, we're only at 2100. So from a percentage standpoint, we ran a lot, right? So if we look at it from a percentage standpoint, I'll put the ruler on here and just show where we went. Like this, we'll put it right on that peak right there. We came down to right about there, right? And that run there is 14.6%. We're down now about 12.2%. So that tells me, yeah, if the markets are a little bit symmetrical like they are, we've got another 1 or 2% to go, which is not a lot. I mean, it's 30 to 50 points, but I think we're going to get a little bit of a rally, and then we're going to kind of bounce around a little bit. Now, notice this area here. We had a rally. Now, this was 308 points to the downside. Now, if we look at this, just so that I can put some perspective on all of this stuff, let's use the ruler again, right? And then we had a rally from here all the way up to here, right? 7.7% up, 138 points. That's a lot, but forget the points, just look at the percentage. We moved up 7.7%, and then we came back and gave it all back up again. All right, now this was in the times where the markets weren't as strong, and earnings, if you remember, we were in a 5-quarter recession, just coming out of it back then. So it gave it all back up. We came all the way back down, and then we started our run here. Okay, so that just, and if we look at it just from a symmetrical standpoint and take the 7.7% run up, let me just get these. Well, I'll leave them on the screen. We'll move over here like this. And then let's just measure 7.7%. Let me just get this squared away right here. So if we measure 7.7% from the run up right here, because it'll be more points because we're at a higher number. Right about there, okay? Notice that was the kind of rally we got that February run. 178 points it takes us surprisingly right up to 2708, right in that area there. That would not surprise me at all to get a rally like that. Now remember, back then it took about 2 weeks to get up there. It was choppy, but we worked our way back up. Okay, that was the rally. And then after that 7% run, right? After that 7% run like that, it came all the way back down and tested it again. And in fact, it went a little bit lower. And then it scared everybody. It flushed a lot of the weak hands out, or even more weak hands that didn't get flushed out here. And then it set us up. That gave us a MACD that moved up like this, came back over, and then we got that huge bullish divergence. I remember this because we were trading the pattern. We were trading it really nicely. Our members that were around, we were doing well. So if we come back into that time again, see, it doesn't look as bad right here, but it is percentage-wise because the markets were 500 points cheaper. So we had that rally up. We had the move up in the MACD. We had it all the way back down again, right? Made a lower low. MACD made a higher one. That was our trigger right there. So I said, let's take some longs here. But then once we cleared that hurdle right there, it was more of a green sign. So we just kind of played a bounce right here, not knowing if we would roll back over because you didn't know. The markets are very emotional. But we played the bounce right here. And then once it cleared it, it never really did a retest. I thought it would. It didn't. There was just too much energy, and away we went. So this kind of scenario can play out. Okay. Now, if we get a rally, but the markets roll over and then you expect a run and we don't get it, there are ways to look at that and catch that as well. We're not going to be caught. You'll never get the bottom and you'll never get the top, but we're just not going to be caught catching it the wrong way. Okay. So this is kind of what I'm looking for. Now, all the other markets look very similar, so I don't need to go through all of them. For our members, we'll go through them this weekend, Sunday night, our weekly market watch. If we look at VIX, you can see that huge vol pop here. If I put it on a weekly chart, you'll see that time period right back here for the China yuan devaluation, right? It did it. It took 2 weeks to get up here. Here, it started down here and it moved up. But this was the fastest 1 week move in vol in the history of the markets. It went up to 50.30. Now back here it went up to 53.29. But it didn't cause liquidation events of ETNs. This one did, the XIB. And you can see where we're sitting here. We're right here in this purple zone. Now notice here, once we get this high up, the markets are spooked. We stayed above 15 for over 6 months. And then we slowly started to average down for another 3 or 4 months with a spike, but we started to average down again. So that's going to suggest that we're going to have a higher vol environment for a minimum of 90 to 120 days, or maybe 180 days, just carrying us out a little bit because of the spikiness nature of this market. So that's going to be good for options traders. And for those of you that are members in our group, you remember when we had this big spike on the 5th of February, I said, if you guys have some cash, now would be a good time when vol was up here and coming down to just go out and put on a couple of small credit spreads. You can get so far out of the money that you just have to have the markets completely collapse to be in danger. But it was you could keep a tighter spread and risk very little to make a real quick amount of money. So that worked out very well for us. But that's what vol did, guys. It was really ugly. If we look at the bond market, this is where it all started, guys, right here, the bond market. And as you guys, especially you guys follow me on the weekends, on these weekly updates, know I've been all over this. We hit my target there, we hit my target there, and we're coming down to hit my target right here, all right? And you can see the target is roughly around 141. And we've already exceeded the vector of the regression channel that I had drawn up here a few weeks ago. So, and we're near the lows here. In fact, we closed almost on the lows for the week down here. I've been short bonds up in this area right here, just riding them down. I think once we get down here, things will settle in a little bit and we'll get a little bit of a bounce. And that bounce moving up means interest rates are going to go down. And if interest rates go down, it'll probably put a little bit more calm in the market. So the markets will go up as well. That'll give us our rally. Then you'll see this roll over, and then you'll see the equity markets probably roll in correlation with the bond market. So that's what the charts seem to indicate at this point in time. If we look at the interest rates, because this is what I first started talking about, and we come out to this weekly chart here, you will see, and let me just take it out to 1994 here, right? This is kind of where, and you can just see how long right here, there's that downsloping trend line. Going back to 1994, and then right in this area here, we broke out of it. I've been talking about it for a while. And I said, we're probably going to come up to that 3% area. But the speed of the movement is what I care about, not the height. Because 3% is still relatively cheap. But a flat up rocket ship move, a space shuttle move, is what's got the markets concerned. Interest rates don't normally move that fast. If we come back into a daily chart, I think we're going to hit that overhead resistance, right? You can see the breakout here between these two resistance and support zones, and now we're coming up to this wider one right here. And then I think this is when the bonds will start to rise, and we'll see a little bit of a consolidation in interest rates. That'll slow the equity market move lower. You'll see equities move a little bit higher. And I know I'm talking about all these different correlations, but that's what worked. This is how the correlations played out last week. And assuming there's not another different shock to the system that's unknown to the system right now, this is what I would expect for next week. Okay. We've seen gold, which tells me the market is still not in a crazy panic. Remember, this big spike up in vol wasn't because of more panic as much as it was the unwinding of the giant short trade in volatility. We had a couple of orders come in over 230,000 contracts after the markets closed on the 5th. I think it was after 4 p.m. It really undid the market, really. It's crazy. And that's what just forced liquidation of some of these ETNs. But look at gold. Gold has been moving down, guys. Now, in a market of fear, gold would not be doing that. It would be doing that. And it's not. So the fact that gold is selling off, when we're coming down to that 1,300 level again, which if I were to, draw it, you can see on the line right here, just the kind of support that this thing holds and the power with which it holds it, right? So it's going to come down there and probably test the 50 EMA, possibly. So the fact that gold is selling off, also there's probably some sell-off because people had margin calls and had to unload things. And we saw but it doesn't tell me that there's that much fear out there, believe it or not. And then, of course, if we look at oil did one of those rare things that I haven't seen in years. What it did was it moved up very strong right here, almost 10%, about 9%. And then it turned right around and gave it right back up again in a very short period of time. Normally, that kind of reversal plays itself out in about 6 months. Here it did it in less than 6 weeks. And in 1 week, it came all the way back down. Maybe 2 weeks, it came all the way back down again. It took about 5 weeks to get up and about 2 weeks to give it back down again. Unbelievable. There was and you could see there were no divergences here. So that would have suggested oil should have caught here. So that tells me that oil was a crowded long trade, and a lot of hedge funds were probably having to meet margin calls and a few other things. So they probably just to take risk off the table, we got oil down here. All right. I don't think, if we look at the volume over price, I think the major support area for oil is right in that area right there. All right. So we're kind of near it already. Right in this area here is kind of where we're sitting, around 56.5 to 56. I don't think we'll break this area. If we do, that means dynamics are changing in the oil market, but that's kind of how it looks at this point in time. All right, everybody, it was a quick run through of the markets. Members, I will see you this Sunday night. We'll go in a little bit more detail and what we can expect for next week. For those of you non-members, I highly encourage you to come in and sign up with us. We've been pretty close to calling these markets for many, many years. Hopefully you guys have been enjoying this weekly roundup. Say that fast a couple of times. Weekly roundup. Hopefully you guys have been enjoying it. I'd like to see you guys come on in and see us on the inside. Everybody else, have a great weekend. Members, I'll see you tomorrow night. Take care, folks. Ciao.